In today's video, we will be discussing the alarming surge of the U.S. national debt to a record level of $34 trillion. This situation can be likened to an individual deeply troubled by credit card debt, continuously overspending and worsening their financial situation. The trajectory indicates a path that is bound to lead to a severe crisis. I aim to provide you with an update on the current status of this critical issue. A century ago, the U.S. national debt stood at $383 billion, and over the past 50 years, it has significantly grown, reaching around $3 trillion. In the last 2 decades, it surged to $12 trillion, and just a decade ago, it escalated to $23 trillion. Presently, the national debt has skyrocketed to $34 trillion, as illustrated in the chart depicting an unsustainable trend. It begs the question, do you genuinely believe that there will be no repercussions from this exponential increase? To delve deeper into this issue, let's explore why the U.S. government finds itself in such significant debt. The situation is quite straightforward. The government consistently spends more money than it earns, leading to borrowing and accumulating debt. Let's examine the breakdown of the U.S. government's income, primarily sourced from individual and Social Security taxes, alongside corporate taxes and smaller contributors like excise taxes and customs duties. Recent figures from December 2023 reveal a stark reality. Total tax income amounted to $429 billion, while expenditures soared to $559 billion, resulting in an overspend of $130 billion. Moving into the fiscal year of 2024, which commenced in October, the government's financial woes persist. December witnessed a budget deficit of $130 billion, which, though significant, pales in comparison to the staggering deficit incurred in November. It's crucial to clarify that this issue transcends partisan lines. It's not a matter of Republicans versus Democrats. Both parties are culpable for overspending and exacerbating the nation's debt burden. We've seen a pattern unfold across different administrations. George Bush, a Republican, contributed to significant overspending and increased debt levels. Following him, Barack Obama, a Democrat, surpassed Bush's expenditures, driving the nation into record debt territory. Then Trump, another Republican, proceeded to outspend Obama, resulting in record debt levels yet again. Now, Biden, a Democrat, has continued this trend by surpassing Trump's spending, leading to even higher debt levels. It's essential to address Congress as a collective entity here. Regardless of party affiliation, politicians must prioritize learning fiscal responsibility and budget balancing. While I acknowledge the political landscape and the necessity of maneuvering through it, there must be a concerted effort to minimize backdoor deals and prioritize financial prudence. All I'm trying to convey is that given the current circumstances, they are really pushing their luck. That's just my perspective. Now let's consider who the USA government owes all this money to. If you take a look, a portion of the debt is owed to foreign countries, indicated by the light blue section on the right. Japan stands out as the largest holder of USA debt, followed by China, the UK, and several others. Domestically, the USA government owes the most to the Federal Reserve. Over the past few years, the Fed has extended substantial loans to the USA government, alongside funds from mutual funds, pension funds, financial institutions, affluent individuals, and more. Allow me to illustrate why the current situation is more alarming than ever. Let's examine the interest expenses incurred by the U.S. government. As the government borrows money, it accrues interest obligations, and these payments are becoming increasingly significant. Take a look at this projection for the 2033 budget. The federal government's expenditure on interest payments is set to surpass that of national defense. What's more concerning is that this shift is expected to occur within the next 5 years, well ahead of 2033. The amount allocated for interest payments will nearly match that spent on Medicare, which is quite remarkable. However, this is just one facet of the issue. Another worry stems from the mounting debt, which could trigger substantial inflation. It's crucial to remember that the primary lender to the USA government is the Federal Reserve, which essentially conjures money out of thin air, a practice that tends to fuel inflation. Let's approach this with a logical perspective. At its simplest, consider how much further into debt the U.S. government is expected to go this year. It's projected to increase by around $2 trillion due to overspending, Consequently, this additional debt will be acquired from the Federal Reserve, which essentially creates this money out of thin air. Now, if we follow this line of reasoning, continuously injecting $2 trillion into the economy annually will inevitably lead to significant inflation. This inflationary pressure exacerbates wealth inequality, with the affluent benefiting while the less privileged suffer. The Federal Reserve's potential actions further support this notion, as discussions about ceasing quantitative tightening and resuming quantitative easing indicate a return to printing money. It's essential to recognize that a $2 trillion deficit would be considered acceptable in a good year, as during a recession, the deficit would likely escalate far beyond that figure, significantly worsening the financial situation. This underscores why the U.S. government is vehemently opposed to the prospect of a recession. The term recession is almost taboo in political and Federal Reserve circles because of the understanding that such an event would send the debt spiraling out of control. In the event of a recession, the U.S. government could accumulate debts totaling $4 to $5 trillion within a single year, a scenario that is entirely feasible. This straightforward logic stems from the fact that during a recession, unemployment rises, resulting in fewer people earning and consequently paying fewer taxes to the government. This reduction in tax revenue exacerbates the fiscal strain on the government. Additionally, the ramifications extend to the stock market, which is expected to perform poorly. This would translate to even fewer capital gains taxes collected by the government. In essence, tax revenues would plummet significantly, potentially by as much as $1 trillion. A figure that can be verified independently. Consequently, the government would find itself in a situation where it needs to allocate more funds to support the economy. As witnessed in previous instances, this could involve various measures, ranging from stimulus checks and tax credits to other incentives aimed at sustaining economic activity and mitigating the impact of a more severe recession. So, what implications does this hold? Essentially, it signifies a decrease in government income leading to reduced tax collections, while simultaneously requiring increased government spending. This inevitably results in larger deficits. Consequently, the nation cannot afford to experience a recession, as it would accelerate the unraveling of the entire economic structure. The worst-case scenario would entail a complete collapse of the system. It's important to understand that the stability of this system relies heavily on faith and ongoing participation. However, if enough credibility in the U.S. dollar and the system as a whole is lost, the entire framework risks collapse. It's crucial to note that the erosion of credibility is a gradual process, not a sudden event akin to flipping a switch. Now, let me outline the process by which faith erodes in the system, leading to its eventual collapse if more individuals, institutions, or even countries lose trust in it. Here's what typically unfolds. Imagine the scenario where the U.S. government seeks to borrow money from you. Naturally, you'd expect the government to compensate you for lending them money, say at a rate of 4% interest annually. Essentially, if you're lending money, you'd want a return that justifies the risk involved. However, if confidence in the system wanes, people may perceive lending to the U.S. government as riskier. Consequently, instead of settling for a 4% interest rate, lenders may demand higher rates. 5%, 6%, 7%, even 8%, to offset the increased risk associated with lending to a government that's viewed as less stable. Subsequently, the interest payments will reach a point where they are no longer manageable for the U.S. government. Consequently, the government will resort to printing more money, causing inflation to soar to levels of 10% or even 15%. Once inflation escalates to such heights, investors will demand even higher interest rates, perhaps reaching 20% as a form of compensation. This sets off a vicious cycle, akin to a debt spiral, wherein the situation rapidly deteriorates. This is the mechanism through which the entire system begins to unravel. According to Penn Wharton, the U.S. debt is on track to become unsustainable, leading to an inevitable default within the next 20 years. Jamie Dimon, CEO of J.P. Morgan Chase, warns of a potential global market upheaval due to the record levels of U.S. debt. He describes this debt spiral as the most foreseeable crisis in history. However, I'd like to conclude on a positive note. The good news is that we're expected to weather through the remainder of this decade without facing a systemic failure. So there's a sense of reassurance for the next several years, I'm trying to remain as positive and hopeful as possible about this situation, and I believe it's encouraging news. That's the latest update. Our politicians seem to be steering us towards a cliff, with the national debt soaring to $34 trillion. I'd appreciate hearing your thoughts on this matter in the comments below. Please subscribe. Thanks for watching. Until next time.